right. Well, thank you, Miguel. So yeah, as Miguel mentioned, please keep yourself on mute. We'll have a Q&A at the end. This webinar is all going to be around sales tax compliance and economic nexus. So Miguel, if you want to get to the next slides, and this is going to be specifically focused for online sellers. So what we're going to kick it off with is what's in the news right now. There's been a lot of news around this over recent times. So we'll get into the headlines today. We'll jump into really quickly who we are, just so you have an idea of who's speaking to you. And then also Ryan will get into sales tax and economic nexus items. We have a list of items that we're going to cover. So we'll let Ryan get to those, and then we'll have Q&A at the end of this as well. Now, one of the main things that we want to teach you here is how to understand what sales tax and what nexus actually means, and what e-commerce sellers should consider when selling not only in their home state, but in various other states around the country. What to do about prior unpaid liabilities through remediation. A lot of online sellers sometimes kickstart the business, get it going, are collecting sales tax, or maybe aren't collecting sales tax. So we're going to want to make sure that we account for that and ways to fix that if you have been doing it incorrectly in the beginning. And don't worry, a lot of people have. So if you're in this boat, it's all good. Then also understanding the hot topics in sales tax and how to stay ahead. You want to be ahead on the sales tax liabilities. Of course, our lawyer insists that you read this. Yes, we are a tax and accounting firm, but everything we say here, it's not legal advice. So don't say, yes, tax hack told me to say it, I did it, and this is the result. Take everything that we say as guidance, as advisory. There's always exceptions, but we don't want that to be you. And then in the news, we'll have Miguel cover some of the more current topics around this.
Yeah, for sure. Thank you, Ashton. I think, when we look at the news, I'm wondering what are clients kind of thinking about and what are you seeing? Right now, I'll let Ryan cover sales tax specific, but the biggest headline that's in the news this week and has been the last few weeks is on the infrastructure bill. So I'm no political expert, but it's sounding that it's becoming, that basically the dust is settling. There were some provisions that I thought weren't going to make it because we had a Republican Congress in 2017 put in landmark tax legislation, and I was convinced that nothing's going to change, which is a bold prediction because there are some things on the table, and those have to do with the highest tax rates as well as corporate tax rates. So today's webinar is not about that, but just letting you know that we're thinking about that. The latest bill also includes a provision on cryptocurrency and how to treat crypto from a tax perspective for those that are mining. Again, don't want to get too much into that, but again, this gets into that whole schism that we crypto enthusiasts and tax people are butting heads with when it comes to how the IRS treats it. And the IRS looks at it as an asset that is being sold for a gain or a loss, just like a capital stock, where a lot of us who actually have crypto and are pro-crypto are like, well, why isn't it treated like a currency from a tax perspective? So the provision in there doesn't get us any closer to kind of the world that we expect to happen, but it does have Congress taking a serious look. So, our view, if you're looking to know what we're saying and seeing, is that crypto is becoming not only a wealth strategy at an individual level, but it's also becoming a treasury strategy to head off what's the big key word right now? Inflation. So 2 months of above 4% inflation, April and May. We're starting to talk to clients about what they're doing. We have clients where the supply chain is just domino affecting into their business, cost of things. And granted, some of these supply chain issues aren't even necessarily disrupted because of just general inflation, but because of supply chain issues. So anybody who is buying from China knows what's happening to the cost of freight right now, how hard it is to find TEUs, these containerized units, because, well, the Suez Canal, I think there's another story where a bunch of containers fell off and are sitting in the Atlantic. So there's a lot of things that are happening supply chain where clients are starting to say, hey, my tech costs because my tech company, my IT company is moving everything onshore because of hack, concerns. their costs are going up. What do I do about my own pricing? So the nice thing about being a business owner is that you're not stuck in a position where your pay is fixed. What a business has the ability to do in the context of inflation is, number one, take on debt, which is an optimal strategy because the cost of debt decreases in an inflationary environment. And then two, to increase your own prices. The price of goods and services are going to rise. And the key question to start asking yourself is, do I have a plan for what, 5% inflation happens every month, which again is crazy. I don't think anyone in my generation remembers what high inflation was, or admittedly wasn't even there. If we're talking about the 1970s, we're starting to at least begin discussions about it because it is very important. And then last thing in the news, got a shout out to our U.S. Olympic team, most golds on the last day. And that right there is my personal hero, Nelly Korda, who won the gold in women's golf. So that said, let me get into key dates before handing this back over. Some key tax dates are coming up. So partnership returns, S-Corp returns due 9/15. 10/15 is the corporate and personal deadline. If you work with us, you know that we do not say, hey, let's get this done around the first week of October. Our internal deadlines are 2 weeks pushed up to approve and file. And the reason why, also, if you're a client, that once you hit the file button, there's a chance that it gets rejected or that we have to make a change. And we can't do that if we hit the file button on the 14th of October. So for our partnerships and S-Corps, our deadline is 9/1 to approve and file. For our C corporations, it's going to be 10/1, and as well as for individuals. So don't want to get too much into that, but administratively, we batch our clients into 2-week deadlines. So if you don't know what your deadline is, feel free to reach out to your tax manager, and they'll let you know or make sure that we're on the same page there. So with that, those minor firm announcements rather, I'll kick it back to Ashton to give the 101 on who you're listening to.
Yeah, definitely. So, Miguel is obviously our founder, and within the tax practice, we have a few different areas that we really serve our clients. One thing that you should get with any tax and accounting firm is compliance and controversy, tax returns, payments, audits, things of that nature, just making sure that everything's compliant. Then reporting and diagnostics, so things around bookkeeping, making sure that your books are compliant, your books are up to date. That's how you're going to generate the profit and loss statement and the different financial statements that are going to be used for tax returns and different annual and quarterly filings. But really, it's around the strategy and the advisory where we really shine. Making sure that we are serving you in the way that you're paying the least amount in taxes as possible, making sure that this money is going back into the business and not just into Uncle Sam's pocket. So we also offer a lot of consulting services and advisory services. And the last one is around credits and incentives. One of the newest tax credits from COVID is the ERTC, the Employee Retention Tax Credit. That one we're helping a lot of our clients get. If you had a very significant loss quarter over quarter anytime in the last year and a half, you would likely qualify for this. And then the R&D tax credit for innovative businesses that are doing innovative things, producing new technology, making new software, anything around MarTech, there's tax credits available. But for the focus of today's call, we want to focus specifically on sales tax. So we invited our sales tax expert here at the firm, Ryan Moss, to the call. So Ryan, I'll turn it over to you. I'll turn it over to you right after this.
After this one.
Yeah, after this one. So that's a nice picture of me when I was a little bit chubbier. So I focus on the credit sides of the business. Mike, he helps with a lot of the tax consulting and the advisory services around the tax credits, around business tax liability. Carla is helpful in the tax compliance. So she does most of our tax returns here, helps on the consulting side as well. And then Ryan, who's about to take over, you'll notice he has a little bit more hair nowadays, but he helps a lot on the compliance side when it comes to sales tax. So with that, now I'll toss it over to you, Ryan.
All right, thanks, Ashton, and thanks for everybody for joining. And I think the main goal of the main message of the call today is I want to give you we want to give you a high level background of this stuff. This isn't meant to be a full scale explanation of each state's sales tax laws. And so I want to leave some time at the end for Q&A, because I think, people don't really understand sales tax right now, especially given the current landscape of sales tax. And I think it'll be important, and please feel free to ask questions. That's what we're here for. And we're happy to help in any way. So with that, let's go ahead and get started. So what is sales tax? Sales tax is a tax on the consumer or the consumable goods. So if you think about when you go to the store, you go to Walmart, you go to, whichever region of the country you're in, whatever the grocery store is, you buy groceries, you pay sales tax on those groceries. So it's meant to be a tax. It obviously generates revenue for states. It's one of the biggest revenue generators for states, along with income tax and unemployment insurance and things like that. But basically, it's a tax on goods and sometimes services, which we'll get into a little later in the discussion. So it's applied to your gross sales. So that's what makes this a huge area here. You think about income tax, you get to report your income and then you get to deduct all of your business expenses. So you're paying tax on your net income. And from a sales tax perspective, you're paying sales tax on your gross sales in a certain state, which, if you've got millions and millions of revenue, it could get burdensome. So, you are allowed adjustments and credits. For example, if you sell something to somebody and they end up returning that, then the next period you could take a credit for that. But generally, it's a pretty large, if it's not done correctly, it can be a pretty large expense item for a business. What is Nexus? So this is a term that you're going to hear. Hopefully by the time we're done here with this webinar, you will be able to understand what Nexus is and what creates it generally. But Nexus is the minimum connection with a state that gives the state the authority to tax you. Generally, that has come in the form of physical presence. So if you think about a situation where, my business, I've got an office in California, right? Clearly you have Nexus there because you have physical presence. Okay, well, how about inventory? How about, I've got a remote employee who works in, Wyoming. Does that mean I have sale or Nexus in Wyoming? So generally the rule is yes. And we'll kind of cover some of the other Nexus topics a little later here, but Nexus in general is basically what gives a state the right to tax you. And then are there different standards for sales tax and Nexus in every state? Yes, which is why it's very difficult to comply on a state-by-state basis. And so the answer to that question is yes, and we'll get into that a little bit more here shortly. Okay, so let's start off. Let's go back in time to June of 2018. And I'm not sure how many of you are familiar with, the landmark court case. Well, for me, it was a landmark. This is on a daily basis, but it basically overruled a previous decision, Quill versus North Dakota. So Quill versus North Dakota, basically, the Supreme Court ruled that in order for a state to tax you, you had to have a physical presence there. So think about, for purposes of this discussion, think about an office location, an employee, or maybe inventory. And that was a pretty old court case. I believe it was from the 70s. I don't know off the top of my head, but in June of 2018, South Dakota sued Wayfair, who the online, the online furniture store, and basically said, listen, you guys are coming in here, you're doing billions of dollars of revenue in our state. How can you argue that you don't have a presence, whether it's physical or, economic presence? So basically what the court decided was, okay, you clearly have a presence in the state. It's not physical, but you have the right to tax Wayfair. And that just set off a domino effect. Every other state, there are a couple out there, maybe one or two out there that don't have the rules yet. Florida just passed a law that not only do you have to worry about physical presence now you have to worry about, okay, well, if I have a certain amount of sales in a state, do I have Nexus? And that's exactly what economic nexus is. Economic nexus is basically the nexus that is not physical in nature, but it can be derived by a certain amount of sales or transaction volume into a state. These laws vary by state, just like anything, and you'll probably hear me say that about 15 or 20 times before it's all said and done. So, and just as an example here, Connecticut's laws say that in order to have economic nexus, you've got to have $250,000 worth of sales and 200 transactions in the state. And by transactions, if you think about an e-commerce seller, you could be selling items that are, 20, 30 bucks, but you could be selling them in mass quantities. And if you do that, that 200 transactions is probably pretty easy to reach. I actually had a client the other day who had like $35,000 worth of sales into a state, but they had like 425 transactions. So, unfortunately I had to get on the phone with her and explain, you don't have a lot of sales, but you've got a lot of volume. So that's kind of what economic nexus is. It's nexus that cannot be seen. Basically, you don't have to have a physical presence anymore, and it's something that's really, really catching fire, and all the states are joining in on the pot, so to say. So, wanted to get into a little bit of just considerations for e-commerce sellers in general. If you think about how all this played out, generally, I think these rules were targeting these big companies, right? Like you think about, and we'll get into Amazon a little bit later, but companies like Amazon, Wayfair, any website that overstock, any website that just have a huge online presence, that was the goal. So what happened? Well, COVID happened. And I think a lot of people said, okay, well, now that I'm stuck at home, I've got some extra time. Maybe I'll start selling these finger paintings or selling these items that, I never thought about doing before because I had a regular full-time job. So I think the reason that we're seeing a lot of work in this area right now is because as a result of COVID and people being at home and not necessarily knowing what to do with all of their time. So, let's talk about the effective dates. So this is number 2 of 20. This varies by state. Some states began immediately enforcing this as soon as that decision came out in the South Dakota versus Wayfair decision. And some states have lagged. Some states have a 1/1/2019 effective date. Some states have Florida just recently enacted it in July of 2021. So, I think there's about 45 states now that have it. I think Missouri is the only one that doesn't have it, that has a sales tax that doesn't have a threshold in statute yet. So it's everywhere. It's all over the place. And we'll talk a little bit more about what it means, for your business or for an e-commerce business a little later. Includable sales and threshold determination. So as I mentioned, it could be 100,000. Say most states are $100,000 of sales. And so, but then you get to the question of, okay, well, Ryan, I sell stuff that's resold. Like I sell items that my customers buy, and then that customer goes and they resell the item to a third party. So that would be an exempt sale because it's a sale for resale generally. But a lot of states, they're going to say, oh, well, that still counts. Some states, it doesn't count. Some states don't count exempt sales in the threshold. Some states do. So it just adds a layer of complexity for determining, okay, do I actually have Nexus in this state? Do I have to register and begin filing sales tax returns? So registration requirements, varies by state. And I can give you one example. Texas, they tax everything. Texas taxes everything, and we'll get into that later. But Texas actually gives you 4 months. So once you reach the threshold, Texas says, okay, well, from the date you reach this threshold, you have 4 months to register and begin filing sales tax returns. Most states are going to require you to register the first of the next month. So let's say we're sitting here at August 12th. Let's say you come to me after this call, or come to Ashton after this call and say, hey, I really just want to get an economic nexus study done. Like I want to know where I've got Nexus, and I want to know what the sales tax implications are. And we say, okay, well, you've got it. we're 8 months, almost 8.5 or 7.5 months through the year. Here's the states where you've got Nexus. Okay, what now? Well, technically the requirement is you register the month after you reach the threshold. So it would be September 1st would be your quote unquote registration date. But once again, it varies by state. Normally what I do is I just register, I let the client know and I say, hey, you might just want to go ahead and get this done, just so we're not forgetting about it in 2-3 weeks. The time period that's utilized in the threshold determination, this varies by state, but a large, vast majority are on a rolling 12-month period. So meaning we're in August right now. So what you would do is you would look at, okay, let's look at your sales exports for August of 2020 and then through August of 2021. And then that's how you make the determination. There are some situations, some states are calendar year, meaning if you don't have it in December of 2021, then you basically don't have it and you can just roll it forward to the next year and see where your sales are at. Not a lot of states are like that because, as you can imagine, they're not going to get as many registrations. Okay, so now that we've talked about, we mentioned Amazon earlier, and we've talked about economic nexus and kind of what that means for e-commerce sellers. Obviously, it's complex and it's a headache. So I'm hoping that this is helping more than it's confusing you. But so marketplace facilitator laws. These are specific laws that are intended for states to collect more sales tax from fewer taxpayers. So what is a marketplace facilitator? Amazon, eBay, Walmart, these stores that have a platform for you to go for a buyer to meet a seller and then they facilitate the sale. And what these states have done, and actually I have a little note here that 47 of the states have enacted these laws. These states are requiring the actual facilitator, so the Amazons, the Walmarts, they're requiring those states to collect sales tax on any sales on their platform and remit it. So what does this mean for sellers that use the Amazon FBA program? You don't have an issue, which is a good thing. And the reason that you don't have an issue is because Amazon's already doing it. And that doesn't mean that you don't have Nexus, but that likely means that you do not have a sales tax liability from the past if you just started selling on Amazon. There are situations where if you are an Amazon FBA seller or you resell stuff on eBay, that you could have liability for prior periods, but we'll get into that a little later. Now, the one thing I want to mention here, Shopify, a lot of our clients sell on Shopify. Shopify is not a marketplace facilitator. So they are not handling this for you. So just wanted to point that out. And that goes for any direct to consumer sales. If you have a website out there that you're selling stuff through, these laws only apply to the Amazons, the Walmarts, the Etsy's, the eBays. So I just want to talk a little bit about remediation. So, okay, here we are, like, let's do the study. We realize, oh, wow, like I've got a pretty big liability in some of these states because I established Nexus, 2.5 years ago, and I haven't done anything about it. So what can we do? So obviously the first step is an economic nexus study. We need to determine where you actually have Nexus. Once we make that determination, then we can say, okay, well, when was Nexus established? When was economic nexus established in these 5 states? We have Nexus, but when did it start? And after that, it's a matter of calculating the exposure, meaning, okay, these are the sales from August of 2021 through the end of 2021. These are the sales right here that should be taxed. So let's say we're in 2022, you've got 6 months worth of sales in one state. You've got, 2 years worth of sales in another state. That's not good. So how do we get out of this hole? And how do we get out of paying interest and penalties? Because this is what happens. I see it all the time. Oh man, like I've got Nexus, I need to go register. So our clients, blindly go and register in these states. And they say, okay, well, yeah, I was doing business in this state 2 years ago. As soon as you put 2 years ago in there, the state's going to come back and require you to file 2 years worth of sales tax returns. So you're going to go in there. Let's say you even hire somebody to file these for you. So you're going to go in there, you're going to file your sales tax returns, and then you're going to get a letter in the mail from the state and says, oh, your return was 2 years late. So here's interest and penalties. You also owe us this. And I know I'm getting a little ahead of myself here, but just for context, penalties and interest together probably range in about the 20 to 30% range. So if you owe a state $100,000, you're going to owe them 130 grand at least, or you can count on that. Interest compounds, the penalties do not compound. Penalties are usually capped at 20%, but the interest is what'll get you sometimes. So how do you deal with this? If you're telling me, Ryan, we can't register, what are we supposed to do about this? There's something called a voluntary disclosure agreement, and these have become very popular. A voluntary disclosure agreement is basically you coming forward to a state, whether it be, most states have specific forms, or you just contact the Department of Revenue and they'll tell you like the steps to take to go through this process. It's a voluntary disclosure, meaning you as the taxpayer are voluntarily coming forward to the state and saying, I had a liability, I have a current outstanding liability, I want to remediate it, like I want to, but I'm coming forward to you. So generally what happens is if a taxpayer admits that they've been wrong in the past, and you can do this for sales tax, I've seen it done for income tax, payroll tax, I mean, a lot of stuff. And they'll waive the interest and they'll waive the penalties. Generally the interest is, generally the interest is going to be assessed, but I actually just did this for a client in California and they had a large balance due and they waived the penalties. They paid the tax plus, a very small amount of interest, and they were done with it. And now they file on a quarterly basis. There is also ways to negotiate this with a state. Let's say you don't have the best record keeping, but you tell them like, listen, hey, I know my sales. I know I probably have a pretty big number out there, but I don't have the records to prove to you that this is the amount I owe. Normally the state will work with you. And normally we don't see this a lot for e-commerce because it's pretty clear. Like, here's your sales exports. Here's the ship to address. Like we know where the sales are going. Right. But they do work with you. One other thing to mention is these are usually only worth the trouble if you anticipate a large liability in any state. So, I mean, if you've got like $20,000 worth of sales in a state, and let's say you have Nexus for the transaction volume threshold. So let's say you were over 200 transactions, you might be selling items that are a little cheaper, but you have a high volume of them. Probably not worth going back and hiring somebody to do a voluntary disclosure agreement for, $20,000 times, let's just say 10%. So $2,000. I mean, the cost will outweigh the benefit in that situation. Now, if you have a $50,000 liability or a $65,000, $100,000 liability, it is definitely worth it because it'll basically eliminate any additional tax, any additional penalties, not interest, but any additional penalties that will be on top of the tax. And this is the best thing about the VDAs. There's something called a statute of limitations. And generally, if you think about this in the IRS or in a federal income tax perspective, usually the IRS has 3 years to audit you. There are exceptions, but usually it's 3 years. So let's say you file your tax return for 2020 today. That means that they have until August 12th, 2024 to audit you. If they don't audit you, they can't audit you. The statute has passed. So that's great. But you have to file in order for that statute to start running. So if you've got, let's say that you've been in business and you've been selling online in California for, I don't know, let's just say 10 years. Statute of limitations doesn't apply to you if you have never filed a sales tax return. So that means that if you go and you register and you put in there that your business started in 2010, and they're going to look at their records and say, we don't have any sort of, this account number doesn't match any filings that we received. They can technically go back and audit you for 10 years, and they will. especially some of the bigger states, California, Texas, Ohio is aggressive. There's states out there that will do that, which is why these VDAs are so important, because generally, if you come forward and tell them like, hey, I made a mistake, like I'm trying to pay this, but the states will limit the look back period, generally 3 or 4 years. So, you know, if you tell them like, hey, like I established, like you come forward anonymously as well, like they don't know who you are. So if you come forward to them, what you're going to say is, hey, like I've had Nexus since 2000, but I just haven't filed. And, you know, I want to remediate this. I want to get it out of the way. So they're going to accept you into that program. And then you're going to file the last 3 years. So it significantly reduces the look back period, especially when you start considering these economic nexus laws and where we're at right now. And I think, Miguel, is there a question? Let's see. Are sales tax penalties deductible? I don't think they are. I think any penalties you pay are non-deductible. So interest is deductible. You can deduct the interest that you pay on the outstanding balance, unless you're subject to 163J, which is the interest expense limitations. But yeah, you can't deduct the penalties. It's straight out of your bank account. Just like the sales tax is if you're not passing it on to your customers. And that's the other thing I wanted to mention here. If you have a Shopify account, and I'll tell this to everybody, but this is very important. Do not charge sales tax if you are not registered in a state. That is a big problem. I mean, it's a big no-no. If you are not registered to do business in that state and you are collecting sales tax, how are you going to remit the sales tax to the state? If you're not registered, you can't do it through sales tax returns because you're not filing. And that's a big no-no. So if you've been doing that, there are ways to get around it, and there are ways to, do the voluntary disclosure agreements, explain what the problems are. But if you haven't done it yet, don't start doing it. It's a big problem. The other thing, if you have a Shopify account and you register for sales tax in a state, immediately begin applying sales tax to your Shopify orders for that state. The reason being is because if you don't charge your customers sales tax, you're paying it, and it's hurting your margins. And I see this so many times. I see this almost on a daily basis where customers, for some reason, or clients, for some reason, they're just not collecting it. And whether maybe they don't know how to do it, maybe they don't know how to put it in Shopify or how to, enable that add-on or whatever, but just ask. We can help you. It takes 5 minutes. Just ask. Okay, so now that we've kind of talked about economic nexus, some of the issues that we've seen, some of the considerations, let's just take a minute, breathe, and talk about some of these topics might not have anything to do with what you're doing. So, listen on, but, maybe this doesn't apply to you. Software. So when I say software, I'm talking about software as a service, software that you download onto your computer, like Adobe, software implementation, platforms. So if you think about like web browser platforms that you can download and modify, things like that, very hot topic. And the reason is because there are so many companies out there just going to tech. Like they're all just about tech. Like they don't want to sell a CD-ROM anymore. They just want to send you a file after you pay them, and you can download it yourself. They don't want to sell property anymore. They don't want you to go to their stores and get something off the shelf. Some people still do. Some companies still do. But generally, when you buy software now, you're probably downloading it from online. So booming tech market, very hot topic. There are a lot of states out there that tax this stuff, especially electronically downloaded software. And the key here is, so software as a service, when I say software as a service, let's just think about like Salesforce. Basically, there's nothing on your computer. If you can take your phone and get online on your phone and log in, to your account online, that's software as a service. You don't need any hardware. You don't need anything. You just need internet access. Electronically downloaded software is when, if you need your computer to get onto that, if you need your computer to get onto it and you downloaded something to have on your hard drive, that's electronically downloaded software. And I'll give you an example. I had a client, recently, they're a SaaS company, and he told me they were a SaaS company. There are a lot fewer states that tax software as a service than there are states that tax electronically downloaded software. So what he told me was, okay, well, it's software as a service, right? So I asked him, I said, is there any component of your services that you have to download something on a company's server or on a customer's laptop or device? And he said, oh yeah, I mean, at the beginning we have to, it's a security type device. So they have to go in there and download something onto the company's servers. And I said, well, you've got a hybrid. And if one of the two is taxable, it's all taxable. So, different states, different determinations, but generally, if there's any downloadable component to software, it's taxable. Another popular one here, digital goods. This is going to vary by state, especially the definition of digital goods. Some states are going to view digital goods as just tangible personal property that's delivered via the internet. So if you think about a PDF file or a PowerPoint or, music downloads, it's very broad. So if a state taxes digital goods, if you're sending a customer something in PDF or you're sending a customer something in PowerPoint, chances are it could be taxable, and you need to do a little bit more research. Another important thing here is there's no one size fits all. There's 50 states. I think there's like 5 or 6 states that don't have a sales tax. So eliminate those 5. Let's just say there's 45 states out there that have a sales tax. Each one of them has a different sales tax code, and each one of them defines these things differently. So California may define something one way, and Arizona might define it another way. So it varies across the states. Highly recommend that if you're in this space or you have customers that are in this space or you work with people that are in this space and they have no idea about sales tax, very important to nip this in the butt now, because it's getting more popular, and it needs to be looked at. And I think on the next slide we've got some examples. Yeah, so these are just some excerpts that I found from certain states, and I'm not going to read them in detail here, but these are just 3 states. So as you can see, let's look at Louisiana, for example. Louisiana considers any digital product tangible personal property, which means let's say you're an e-commerce seller and you sell someone a t-shirt. Obviously that's property, right? Like you're selling something, obviously that's taxable. Well, let's say that you send them a design. Let's say that you provide them a design for their t-shirt. What Louisiana says is that's the same thing as providing property. Iowa, this is incorrect. They just changed their legislation. But previously Iowa specifically exempted any product delivered digitally. So anything that was downloaded to your computer, anything that was provided in an email, not taxable. Iowa explicitly defined it as non-taxable. Kansas is a little bit different. They have sort of like a hybrid approach between these two, basically saying that digital products, services, and information can be sold and delivered over the internet. Non-taxable sales include electronic downloads of movies, music, and they're not taxed because they're not tangible property. But Kansas does have certain enumerated services and products that are taxable. Probably not very broad. They're very specific, but there are situations where Kansas will tax digital products depending on the nature of the product. Next slide, please. Okay, so I hope everyone, and I'm going to leave some more time for questions here after this, but, just final thoughts. Take action now. Don't wait to do this stuff because it's important and it could affect your bottom line. I get this question all the time. Oh, well, how are these states going to find me? Like, let's say I'm doing $5 million of sales a year. Like, how are these companies going to find me? There's two ways. The first and most common way is you're selling to customers who aren't paying sales tax. So what if they get a use tax audit? Like, what if let's say you sell something to a customer in Arizona, and then that company, or that, it would be a company, but let's say that company undergoes, like, let's say they get audited for use tax. Well, if the auditor goes in and says, oh, wow, like you're making a lot of purchases from this company and they're not charging you sales tax, you need to pay use tax. I guarantee you that auditor is going to write that company's name down and look them up to see where they're located, and, probably will send a letter about it. That's the most common way your customers get audited for use tax. The second way is some states require credit card companies to disclose certain transactions. This is less popular because it's not every state that does this, but there are states that say, hey, you got to send us a listing of all the transactions that occurred on this date, like banking regulations, things like that. So it's certainly possible that you could be found out that way. I actually had a client about a month and a half ago, in North Carolina. I'm located in North Carolina. This company was in North Carolina. They got an audit letter from Washington State, and it said it was a Nexus questionnaire. And the very first question is, are you a remote seller? They had to answer yes. The second question was, what is your total annual revenue derived from sources within the state? And they had to put the number. It was like 200 something thousand. They sent this questionnaire back, just a random, in the mail. They got it. I have no idea how they found them out, but they did. A week later, they sent them a notice of audit and said, hey, we're auditing you. Here's the records we need. So they didn't get a chance to do the voluntary disclosure agreements because they got audited. So if you have, if you receive any correspondence from a state prior to the voluntary disclosure agreement process being undertaken, you're out of the bucket. You can't do the VDA anymore. So as far as, obviously I've recommended that an economic nexus study be performed. That's the first step, because you may do the study and realize, oh, I'm good. Like, I've got nothing else to do. But you could do the study and find out, wow, I really need to get this under control and start charging my customers before I go bankrupt. So that's a very important topic, very important step. And if you're a seller on Amazon, consider the applicability of marketplace facilitator laws. Like, you might have Nexus, but you might not have any sales tax obligations, which in that case, I would probably recommend you just don't worry about it, because you're going to spend money, having people file your sales tax returns, and you don't have to pay anything. So let's just say you're an Amazon seller and the state audits you, they're going to say, okay, well, you have Nexus, you should have filed these returns, but generally any penalties are due based on the outstanding balance of tax due. So if you don't have a balance of tax due from those periods, you're going to have like a $20, $50 non-filing fee. So, very small exposure there for Amazon sellers. Last thought, begin registering for sales tax after the economic nexus study. The quicker that you can pass this stuff on to your customers, the quicker you don't have to worry about it anymore. That's the bottom line, is until you do this, until you take action, there is always the risk that a state's going to audit you and you're out, thousands and thousands of dollars because you never had the study performed, you're not registered in the state. And then, take action now. Don't wait. It's not worth it, especially if your business is growing. If your business is growing, you need to nip this in the butt now before it gets to the point where you could really be crippled by a state coming in and assessing you interest, penalties, non-filing fees. It could just get messy. So, that's all I have. I appreciate everybody's time. Hopefully I left enough time here for questions. And I think, Ashton, you have your email on here in case there's some shy folks who don't want to ask live, but certainly I think You can email Ashton, he can get back to me. So there's a question here. When you have a hybrid SaaS product, is it possible to split out taxable versus non-taxable sales channels and then just pay on the taxable channel? That's a really good question. It's possible if your invoice includes that. So there's something, and these are more construction contract related, but there's what's called a lump sum contract, and then there's what's called a separately stated contract. If you charge your customers for the downloadable component as well as the monthly access for the software as a service, let's say, and you get audited, well, the auditor is going to look at that and say, oh, okay, well, SaaS isn't taxable, but this downloadable component is. So yes. And then likewise, if you charge your customer the sales tax, you only have to charge them a part that's broken out separately. The problem people run into is they just send a contract to their customer that says for software or a description of what they're providing. And if you get audited and a state comes, the first thing they do is they look at your contracts. And if you get audited and they see, oh, well, there's no breakout, so we can't determine what the value of each of the service or the products is, so the whole thing is taxable. I've seen that happen numerous times where a state says, you have to prove to us that the value of the downloadable component is less than X% of the total value of the invoice or of the contract. Most companies can't prove it. The whole thing is taxable. So that's a really good question. It is possible, but you need to break them out separately on your invoices to customers. Are tech companies that sell private user data going to have to pay sales tax on that data if it's considered a digital product? So it would not be. Answer is yes. There are states out there that tax information services, and generally information services, if they're not proprietary, and what I mean by that is, let's say, I'll give you an example. And let's say in this situation, let's say I'm a tech company and I'm Facebook, and I'm gathering all this data, and I am selling it to, 15 different people. That's information services. So in some states that's taxable, yes. Now, in another situation, let's say that I'm Facebook and I'm only selling this information to one person. It's personal in nature. It's there are situations where this isn't the case, but if it's personal in nature, it would not be taxable as information services. So, if you're a company out there and you're collecting data and selling it to other people, there's a good chance that if you live in a state or you're selling it to a state that taxes that service, that it would be subject to sales tax. Are there particular states to worry more about? I've seen a lot of Texas sales tax audits. They audit everybody. Doesn't matter what you do. So I would definitely say Texas, California, Ohio, Louisiana, New York, Connecticut. Those are just some that come to mind that are very aggressive. And so, if you're doing business in those states, I don't want to say that they're more aggressive than others. I see more issues with those states. I see a lot of clients that have notices of audits from Texas, California, Connecticut. And those consequentially are the states, Texas in particular. I mean, Texas taxes everything. They're just one of those states that chances are, if you're selling something to somebody that has internet access, it could either be data processing, digital products, software as a service, electronically downloaded software. I mean, they have such a broad definition of these things that Ohio does as well. California is a little less broad and it's a little bit more defined, a little less ambiguity there. But Texas definitely, and Ohio, those are just some of the states that I personally would be more worried about, especially as an e-commerce seller, because they'll get you.
Great. Oh yeah,
Hey Ashton, I think there's one more question.
Yep.
We deliver adverts online, clients are nationwide, ads are delivered to consumers nationwide. How are we taxed? So the advertising services generally aren't taxable. There's only a few states that tax advertising services. The fact that the clients are nationwide could have Nexus implications. So, and this is kind of the whole situation where you've got information services. So if you're selling, and maybe we can take this offline, but generally advertising services aren't subject to tax. It's going to depend on what the contract says. So like if you're solely providing services, like if you're solely just saying, okay, you're telling a customer, here's what you need to do with your website, here's what you need to do with your marketing, that's probably not a problem. If you're doing advertisements and you're actually manipulating their data and you're going onto their website, and you're, let's say you're doing SEO type stuff and you're manipulating their code and their website, something like that, very good chance it could be taxable as data processing. Only a few states tax data processing. I would say for this particular scenario, though, there's probably a few target states that you'd want to be worried about, because generally states aren't going to tax professional services. But there are some states out there that will, and hopefully you don't operate in those states. But it's probably something to have a conversation about, at least, maybe review a contract or two just to see what's actually being provided. I definitely think that would be worth your time. Now, I give it another minute here, Ashton, and then I think we can wrap it up if there are no more questions.
Okay. Yeah, so we'll just give it maybe another 30 seconds or so, see if anyone has any last minute questions. You can type them out or feel free to unmute yourself and ask. I know sales tax is one of the more complicated, tedious processes of selling online, but it's an important one. It definitely, you need to ensure compliance. You don't want to get hit with any penalties. And, if you're collecting sales tax without remitting it to the state, then a whole lot of other problems can come as well. So just want to make sure that you have that set up correctly. On our website at mytaxhack.com, we have a lot of good blog posts that are around sales tax, around just different information for online sellers. So if you ever have any questions or anything, my email is right there, ashton@mytaxhack.com. Ryan is ryan@mytaxhack.com, but come through me first. I'll get you connected. So I think we're good. Looks like no more questions. So Ryan, thank you very much for the time. Everyone that joined, we appreciate you joining the webinar. Miguel, thank you. Before we go, goodbye. Take care.